Multiple time frame analysis can be overwhelming for some. In one frame, we're in an uptrend, while in another time frame, we are in a downtrend. And if you add in more time frames to check for confirmation, and confusion can become so severe that people just tend to simply freeze. The issue is that there comes a time where the time frames mesh, and either the higher or the lower time frame will take over. Patterns in one time frame take on a whole new meaning when looked at in the context of another time frame. There is the belief that the higher time frame carries more weight. But remember, at any time, one time frame can take over and a turnover can happen. The trick is to determine which time frame and structure is the one with the more power. And in this piece, I want to give you how to draw different trend lines, how to determine trend, and how to trade counter trend using trend lines. Now, since the trend on one time frame can become the dominant trend at any time, it's not a bad idea to see where we are in the bigger picture. Trend lines are good tools to use for trend determination, and in the right hands, they can become a standalone trading tool. Not only can they help determine your trend direction, they can also point to the rate of the trend, which is great information to have in terms of taking a trade. In defining how to draw a trend line, we open an entirely different issue. Connecting swings in price can be subjective, especially if we include the internal trend lines. The key is really to just be consistent at every turn when you draw your lines. Now, this is the standard way of drawing trend lines, and because we're using the same anchor for different swings, this is known as fanning a trend line. Trend lines define the relationship between the swings that are used and are useful to determine an accelerating or decelerating trend. Number one, you can see how the line starts off steep and slowly begins to decrease in the steepness of the line. Number two, smaller trend lines marking off the corrections are short-term trend lines, and they can be useful in determining a trade entry. Number three, internal trend lines also offer opportunity in terms of trade opportunity, as they can be useful in an early warning of trend reversals. Now, one way you become more objective in trendline usage is to only connect to the obvious swings and only after a high or a low is taken out. Now, the drawing of trend lines, it's not very difficult. And now the question becomes, well, how to use that information to aid us in our decision making? Now, drawing lines on the higher time frame charts is simple, as you have less swings to deal with. Now, this chart has a daily downtrend using trend lines. It's not seen due to space limitations. And now this is an intraday chart using the 1 hour time frame. You can see we have a few more options as the amount of swings has increased. Now, keep in mind this is a 60-minute chart in the context of a daily downtrend. The daily downtrend has been determined by drawing trend lines over obvious swing highs. Number one, these dashed lines are used to form downtrend lines and kept you on the short side intraday or provided targets for counter trend trades. Now, all three of them have been broken. Number two, we started to get higher swing lows, which allowed us to draw uptrend lines off the lows. Each time price met a downtrend line, it gave inflection points for possible actions. And number three, you can see the lines getting steeper, indicating the rate of uptrend was increasing in the context of a higher time frame downtrend. Now, when the trend starts to increase, you can see the trend line is taking a more sharper direction. And in this case, we may be seeing a resumption of the overall downtrend. Now, one thing I hope you've noticed is that at each line, there is some sort of reaction. Now, this does not always happen, of course, but it's something to take note of. Now, oftentimes when a trend line breaks, it's simply moving into another trend rate that's either new or has been shown through an earlier trend line. Keeping in mind previous rates of trend plus the larger time frame trend can help keep you from being overly anxious to jump into a move. Now, I want to dial down into each point in time where price met one of the dotted lines. Dropping the time frame to a factor of 4 allows a better view of the action and possible opportunity around each point. Now, I have to reiterate that we're in a downtrend on the daily chart, which we objectively know through our trend line. I must also add that if we continue up from this current area, there's not a trend line offering an inflection point on the previous chart. Number one, after price breaks the lowest trend line, it reacts off the upper trend line. Number two, after reacting at number one, price returns to the breakout price zone and offers a trading opportunity. Number three, price breaks through the tested trend line and travels all the way to another trend line before number four, offering a pullback trade opportunity off of a formed demand line. Number five, Price breaks up through the tested trend line and is now sitting at a make or break point. The point is that even though we're in a higher time frame downtrend, the usage of trend lines offered not only a time frame dependent uptrend, but also trading opportunities. In a future piece, I'm going to expand on the usage of trend lines, including channels. But for now, take it upon yourself to lay out a trade plan using the trend line information found above. It may not be a plan that you trade, but it will give you great insight on how valuable trend lines can be for your trading and may find its way into your trading. Now, trend lines can help you define the strength of a trend, if a trend is even present, and perhaps give you a signal that the current move is coming to an end through a parabolic push. Just be consistent and clear with their usage.